Good evening, everyone, and thank you for being here. And, whether you're actively shopping, thinking about buying, or just exploring your options, you're in the right place. And, I got to be honest. Like I said, I've done this a long time, and this has not been the easiest market that I have seen. It's been really, really challenging, and it looks like the affordability goalpost just keeps moving further and further. And you know what? We're not talking about housing affordability in Washington. We're not talking about housing affordability in Austin. But even without that, I believe that this is a strategic market with preparation where sellers are more flexible than they've been in the past, and buyers who are prepared, it can represent a real opportunity. And that's what we're going to focus on tonight, a clear, practical way to navigate this market. Here's the promise for tonight. Clarity about readiness, preparation, financing choices, and how to compete strategically. And it's going to be the last thing we discuss. And I'm going to tell some real stories about how we were able to help folks compete strategically and not save hundreds of dollars, not save thousands of dollars, save tens of thousands of dollars. But first we're going to talk about is it financially? Are you financially and strategically ready to buy a home? Know what you need to do to prepare before you shop for a home. Understand the financing process and the programs that fit you and your lifestyle and your goals, and then use a coordinated strategy to compete in this market. But before we do that, hey, I want to introduce a couple of very special folks that are here with me this evening. Natalie Botchick. Did I get that right?
You did.
I've been practicing, for a long time. And Natalie, please introduce yourself.
Hi, my name is Natalie. I'm VP of Sales for Black Label Title. It's a boutique title company in the Houston area. Prior to that, I was in corporate title, and before that, I was actually a realtor. So I do understand the hurdles that you guys go through when it comes to buying and selling. We're basically your last stop when it comes to the title or the transaction side, because you have to get pre-approved. You have to, find that house, and then we're the people who basically clear up title for you. So it's very important to have a good relationship when it comes to the title side and knowing where your transaction is, because most of the time that's kind of where things go silent. And so I'm happy to work with people like Mack and Nicholas, who are very well versed, and they understand how to maneuver through the economy like this, because a lot of times people just look at the dollar signs. They don't look at creative ways or different ways to get you pre-qualified, especially in different markets. So I'm looking forward to, hearing from you all, and I hope you guys learn a lot from this event. Thank you.
Thank you, Natalie. Nicholas, please introduce yourself.
Yeah, absolutely. Thank you so much. And thank you, Natalie. I'm the person that you talk to kind of in between, right? So you're going to first go talk to Mac and make sure the numbers make sense. You're going to make sure that he gets you squared away as far as what you can afford and what you're comfortable with, of course. And then I'm the person that's going to do the fun stuff. I call my job the fun job, because all I go do, we just go out and look at houses. We go shop, right? So that's usually the exciting part of this process. And so I've been doing this since 2005. I started when I was 5 years old, so I'm fairly young. But I really enjoy working with first-time home buyers, folks that are moving up, moving down as far as home size. I've helped them all, and so investors as well. So really looking forward to today's webinar and learning a little bit more about some of the challenges that people are going through today. And Mac has done a wonderful job of helping people overcome those challenges. And so, again, just echoing Natalie's words, I'm happy to work with both of them, and looking forward to meeting several of you here today as well. Thanks, Mac.
Thank you, Nick. Thank you, Nick. Thank you, Natalie. And hey, I'm Mack Blankenship, aka MortgageMack, and you know what? We help you and your real estate agents win. And I'm also managing partner at Ray, husband, Grandfather, 7-time Ironman finisher and former guide to blind athletes. And I've spent my lifetime planning, preparing, and serving others. And that's what I believe my role is as a federally licensed mortgage loan originator, serve the public to create a path to homeownership so that people can have housing security in their life. And here's the one thing that I do know that is true. Preparation creates opportunity. And that's what we're going to do this evening. And now that you met the team, let's dive into this evening's event. No, knowledge, well, is the beginning. Confident action is the goal. And what we plan to discuss this evening is to educate you so that your choices are clear and that you're confident about those choices, to empower you to make good decisions and to prepare you to execute and create a meaningful experience that's different, right? And I have I'm over 200 5-star reviews as of this past week. And I believe that the reason that we've been successful is we create an experience that's different than what people are accustomed to experiencing in this mortgage process, because it is full of anxiety, but you can mitigate the anxiety with preparation. So the first decision is foundational. And hey, let's talk about why we would even want to buy.
I can't do this anymore. I can't. I give and you take. When I ask you to do something or even fix something for me, you just ghost. But when you need money, you're all over me, like all stocky and weird. This is so not working anymore. I need my space. So whatever this even is, it's over. Wait a sec. Does this mean you're not renewing your lease?
So please give me hands up. Who wants to fire their landlord? Anybody? Please drop me a note in the chat session. And hey, whose rent has gone up? And what extra value did you get out of that? Rent pays for housing. Ownership builds equity and creates housing stability in folks' life. And it actually gives you more control of your life, because one of the biggest challenges I see for renters is that annual renewal notice, right? And homeownership, however, brings responsibility. It brings responsibility for things that you actually pay for, right? But you just don't know that you pay for it, which include maintenance, taxes, insurance, and more responsibility, because you would be responsible for those items when you became the homeowner, but clearly you pay for those in your rent currently for the landlord. So the real question is not simply whether homeownership is good, it's whether or not we are ready for it. And readiness is not a feeling. It is objective clarity about 4 items. Credit. Understand what is on your report and how you are managing your current debt. Budget. Finding a payment, choosing a payment that still leaves room to live, to save, and to sleep at night. Savings, plan for upfront funds, right, in case of emergencies, reserves, and just the overall responsibility of owning a home. And finally, income. Is my job stable? Is my income supportive of a mortgage payment? And that we would be specifically related to budgeting. And once we know where you stand, the next move is to replace the guesswork and begin to build a roadmap. And so if in this particular slide, the QR code here, if you click on the QR code, it will bring you to our first-time homebuyer guide. And it's very, very thorough. This entire presentation is based on that book, but it is just far more detailed. And you'll learn the major stages and be able to build your team, which you're doing this evening. But also, it'll encourage you and share with you in detail the things that you need to do to get pre-approved before you seriously shop for a home. And many buyers over my 33-year career, they just get pre-qualified. And really all that means is they apply, they give me their information verbally, but they don't necessarily provide the pay stubs, the bank statements, and the verification of those things. And we are very much in a believer, and we'll show you why it's important at the end why you have to get pre-approved. And once the roadmap is in place, it's all about the numbers. And the basics come down to credit, cash, budget, and an accurate monthly payment that you are comfortable living with and making on a monthly basis. So let's start with credit. Is it important? Yeah, it's really, really important, but it is just a planning tool, and it's not a moral scorecard. Credit can affect eligibility, clearly, whether or not you get approved or not, but it can also affect interest rate, down payment, choices, and mortgage insurance costs. And what I encourage folks to do, go to annualcreditreport.com, review your report early enough to correct any errors that may exist and address avoidable problems that may exist. And I'll give you a great example. An application last night is I pulled the credit report, and there were multiple items on the credit that did not belong to my borrower. They belonged to someone else, and it was called an authorized user. And they were quite large, and without the removal of those, we don't qualify. So we have to get those removed before we're actually going to be able to get her approved. So a credit score is only a snapshot, though. The report behind it tells the lender the story that we need to understand so that we feel comfortable lending the money. And so think of your credit score as a headline and the history as the story. And we're looking at payment history, shows whether obligations are being paid on time and if they're being handled consistently. Balances and available credit will show how much pressure your budget might already be under. And recent inquiries or new accounts may change the picture during that loan process. And we'll talk about that, some do not do's. And one of the do not do's is don't apply for credit when you start the home loan process, okay? And, a few simple guardrails can protect you from finding yourself in a position where you might your pre-approval could be in jeopardy. So from pre-approval through closing, let's keep the financial picture steady. And what that means is let's pay every account on time and keep our revolving balances controlled. And that means, hey, if I have a $10,000 credit card and the balance on it when I apply is only $3,000, let's not run it up to $9,000, okay? Let's avoid new credit. Let's avoid making large purchases, and let's not move money or make large deposits. And from sources, let's discuss it first. And hey, over my career, I've sold lots and lots of folks buy the home first, the new car second, because I've seen lots of folks buy that new car and then come to me and want to buy a home. And, the car doesn't allow their debt to income ratio, which we'll talk about debt to income ratio here momentarily. It doesn't allow them to qualify anymore. So with credit protected, we're going to talk about a myth that stops a lot of people from even applying. And that is down payment. You don't need 20%. And the right amount for your down payment just depends on you and your situation, and could also be based upon the property and a multitude of other factors. But we have conventional loan programs with as little as 1% down, 3% down. FHA, which is administered by HUD, will allow as little as 3.5% down for eligible borrowers. And hey, for veterans out there, you can put as little as 0 down to buy a home. And there is also, for rural areas, there is a USDA home loan program where the down payment is 0. But keep in mind, a smaller down payment preserves the savings, but it does impact the mortgage insurance, the loan rate, and the overall monthly payments. Because clearly, the more you can put down, the lower the payment. So we should plan for more than just the down payment as well. We need to plan for closing costs. We need to plan for taxes. We need to plan for insurance. We need to plan for inspections, appraisals, surveys, and even cash reserves. And what that is, it's, hey, how much money do I have for groceries after I buy my home? And in today's market, it's highly likely that with the right plan, we might be able to get seller credits to help us with some of that. So the smartest down payment is not always the largest one. It's the one that supports the payment you can afford. So the maximum amount a lender can approve and the amount you should comfortably spend are not always the same. Debt to income ratio compares monthly debt obligations with your qualifying income. Approval also reflects credit, assets, loan type, and property specific taxes, insurance, and homeowners association dues. And the way that we operate is we encourage folks when we visit, let's bring a real property, a real address, a home that's for sale, even if it's just something that's already sold. And what we do is put together a financial profile for that home and measure that financial profile against your income, how much money you have saved, and see if we can find that sweet spot that works for you for monthly payment, works for you for your cash to close, and works for us for qualifying. So to choose that comfort level, though, we need to look beyond just the principal and interest, because I'm sure as many of you already know that the number that belongs in your budget isn't just the house payment. There's also taxes, insurance, homeowners association dues for properties that exist inside of a homeowners association, and homeowners insurance, which has been rising quite substantially, and mortgage insurance as well. And mortgage insurance is an insurance policy that you pay for that insures the lender against default. And it is truly what allows for you to be able to buy a home with as little as 1% down, 3% down, because we use that insurance, we bring that insurance in, that insurance company says, hey, if Mr. and Mrs. John Doe foreclose, Mr. Lender will pay you a certain amount based upon the remaining balance of the loan. Now, on a fixed rate loan, the principal and interest stays fixed for the life of the loan. But I want to caution you, taxes and insurance can change throughout the life of the loan. And I can tell you that in my own personal mortgage, that after COVID, I saw insurance just go way up, right? And you know what that means? I'm going to fire my insurance agent. And you know what? I did. And I went shop for more insurance somewhere else and was able to get my payment back down. But, you know, post-COVID, taxes and insurance went up quite a bit. So part of that payment may also be collected through a term that you're going to hear in the loan process, and it's called an escrow account. And an escrow account simply means money is held and managed for a specific purpose by a third party. And in our instance, that third party would be Natalie's team. That is one of the functions of Natalie and the title company. And when you and Nick go out and you write an offer on a home, you'll make a deposit of what we call earnest money on the home, and Natalie's team will hold that money as a third independent party, and they'll hold that money in a separate account. And then once you get to closing, it'll be used for a portion of your down payment. And after closing, there is also an escrow account, which is funded by you at closing so that the lender or the servicer that you make your payment to can collect and ensure that your taxes are paid when they're due annually, ensure that the insurance is paid when they're due annually. And what that does is that escrow account allows you to make monthly installment payments during the year so that you don't have to have a large insurance bill or a large tax bill at the end of every year. So we're going to move into loan choices, but here's what I'd like to do. Let's pause for a moment, see if there's any questions, and hey, did you learn anything so far? I would be really, really excited if you could drop me a note in the chat session, please. Okay. All right. So we are going to keep moving along. Lots and lots of information to cover this evening. Okay, the best mortgage is not simply the one with the lowest advertised rate. It is the structure that fits your goal, cash flow. Do we have any questions? Thank you. Thank you, Stephanie, Antonio. Thank you. So the best mortgage is not simply the one with the lowest advertised rate. It is the structure that fits your goals, cash flow, your budget, and your expected time frame in the home. A lot of folks come to me and said, hey, we're only going to be in this home 5, maybe 10 years max. And so what we'll do is we'll begin with the most dominant mortgage loan program that exists in the marketplace, and it's a fixed rate, and it's what most people do. But I do have folks that come to me, like I said, and said, hey, especially folks that get relocated and or have some event in their life that they know is going to happen, and they know that they're going to be moving out of that home in a specific period of time. But a fixed rate mortgage is predictable. And it's what I have, and it's what most of my borrowers have. The interest rate and principal and interest payment remain fixed for the life of the loan. And this total payment, as we discussed, can still change. Taxes can change. Insurance can change. Mortgage insurance hardly ever changes. It does not change. But association dues can change. And this may fit buyers who value stability or expect to own the home for a long time, right? And this is the product that I advise for most first-time home buyers. And if your time horizon is different, though, and you think you might be moving and or buying another home, an adjustable rate or ARM might be a good option for you. Now, adjustable rates generally have a fixed period in the very beginning, where the interest rate is fixed for 3 years, 5 years, 7 years. And it does have caps and limitations after that 3, 5, or 7 year, where, hey, the interest rate can go up after that time frame, but there are varying caps and or limits to those changes. And an ARM, can be a strategic for short time frame at which you plan to own the home. And fixed and adjustable loans are two tools, but there are other programs that I think that might benefit you.
Worry you don't have the funds to buy your first home? Well, don't lose hope until you've checked out all the many programs and resources that can help. Like FHA loans, USDA loans, VA loans, May loans, Freddie Mac loans, the FHA Energy Efficient Program, Freddie Mac Home One, the Trinoa Fund, Community Seconds, and the FHA 203K program. Then there's the National Home Buyers Fund Diamond Program, the VA Renovation Program, Fannie Mae Home Ready, Freddie Mac Home Possible, and even a federal penalty waiver for buyers who tap into their IRA account. Not to mention all the many, many other programs on the state level. And the best way to get a handle on these resources, just call, text, or email your guaranteed rate loan officer today.
Yeah. So there's probably 150 different loan programs out there. And look, the key is to have somebody with experience and a good team to help match the right loan program for you. But just on the surface, conventional loans are the loan type that I do the most of, and it's Fannie Mae, Freddie Mac administer those. I'm sure you've heard those terms. And then there's non-QM loans that work really, really well for self-employed borrowers. And we also offer renovation loans, which, hey, if you find a home that you want to live in and it needs to be renovated, we have a loan program for that. And then we also offer FHA, VA, USDA, and there's just tons and tons of options out there. And the best one for you is, and the only way for us to be able to discover that would be to apply, spend some quality time together with somebody you like and trust, and then figure out which of the loan programs would best suit your needs specific to payment and cash to close. And a lot of these programs have and work alongside affordable housing loan programs. And these affordable housing loan programs, they have a lot of value that they offer, but they are have some eligibility requirements, and many of those eligibility incentives depend upon geography, where the home is located, income, and or both. VA and USDA, as I mentioned earlier, is they offer zero down for eligible borrowers. And then there's housing agencies or housing finance agencies like Texas Department of Housing and Community Affairs and Texas State Affordable Housing Corporation. They offer down payment assistance upwards of 2 to 5%, along with mortgage credit certificates. We do lots and lots of those. And those are great programs, especially designed for folks that have, you know, reasonably decent credit, right? And maybe just not as much savings that they would like to have. But look, if you have credit and you have a little bit of savings, I helped a couple move in just recently with down payment assistance, and I think she actually got money back at closing. So we were able to, once we got her pre-approved, we were able to go in and negotiate seller concessions. We took the seller concessions along with the down payment assistance, and she moved in for $2,000. Bought a new home. Pretty crazy. So, so with that said, let's sort of walk through the steps to a perfect loan. And a clear process removes surprises. Surprises for you, surprises for me, surprises for Nick, surprises for Natalie. And, you know, after 33 years in the mortgage industry, I just don't like surprises at all. Just tell me what you're going to get me for my birthday. Just tell me what you're going to get for Christmas. But step one begins before the home search. And it's all about apply and get approved. And, you know, a lot of lenders offer what they call pre-qualifications. And I highly recommend, hey, that's a starting point, but work with your lender. Take that next step. Put your financial documents together and put the pay stubs together, the bank statements together, and the tax returns, and let the lender's team process, submit the loan to an underwriter. An underwriter is a person inside of the mortgage company who has the authority to approve your loan and authorize the lender to actually lend you the money so that you can bring, that we actually send it to Natalie's office and they pay the seller and the home becomes yours. And it starts with a complete application. And if you believe you'd like to get started, you can always get started at MortgageMack.com is where my application is located. It's a secure loan application, and we also have a mobile app, and you can click on the QR code, download our mobile app. It's just a world-class mobile application, and then provide the requested income, asset, credit, and identity documents. And look, if you're competing as a buyer and you're looking to leverage a negotiation on a concession, looking to win the offer. I had an offer offer situation over the weekend where we had multiple offers, and our buyer was pre-approved. And I don't know if the other buyers were already pre-approved, but I assume that they were not, because my offer from my pre-approved buyer was accepted. And I got to believe that the reason it was accepted is because our buyer had gone through the mortgage process for income, for credit, and assets, and we issued a formal letter of approval, which speaks volumes to a seller and to their agent. And so with that defined, now let's go shop for the right home. Let's go hang out with Nick and let's go find the right house. And pre-approval does not tell you which house to buy, but it gives your team, gives Nick boundaries, gives you boundaries. And it says, hey, you know, this is our price range. This is our monthly payment maximum. And generally what we'll do together is define, along with Nick, define that geographic area to ensure that the payment falls within the framework of what we planned on. I can tell you, I live in Brazoria County. If I go on the other side of 288, the taxes, not the taxes, but the insurance is far more expensive where I live than it would be somewhere different in a different neighborhood just in Pearland. So work with your agent, work with your loan officer, and together we'll find the right house with the right payment and then begin to prepare you to go in and make an offer, inspect the property, and hey, we'll even spend some time with you, recalculate those payments, and make sure that it falls within the framework of your expectations. And hey, after that, execute a contract. We're going to go in, you're going to sign documents, and you're going to submit a contract. And this moves from planning to deadlines. And it's really, really important at that stage that we really be prepared to execute. And we talked about education. We talked about empowerment. Now, when that contract is signed, it's really about executing the inspections that we encourage you to do, executing, getting your documents together to the lender in a reasonable time frame so that we can meet the deadlines that are outlined inside of the contract, because not meeting those deadlines can be costly. And once the property is identified, underwriting, now we can obtain approval. And now we already had loan approval for you, but when we say obtain conditional approval, we're actually talking about the property, because we want to approve the property just like we approved you. And generally what we find is that we need some updated pay stubs, maybe bank statements from you, but this is where we're going to go in and we're going to inspect the property, we're going to appraise the property, we may even have to survey the property, and all within the framework of the deadlines outlined in that paperwork. And once all that comes together, well, we get to go visit Natalie. And let me tell you, they have great snacks, and generally there's going to be a surprise for you at closing in the form of a gift. And look, the whole idea behind this is to prepare so that when you get to the closing table, when you get to Natalie's office, you have a meaningful experience and you're comfortable with the decisions that you've made. And generally, what will happen here is you're going to get a closing disclosure, and we send it 3 days before the actual closing, but you'll get the final one at your closing. And look, we believe in planning, and we help our borrowers plan up front so that when they get to the closing table, the payment is what we expected, the cash to close is what we expected. And then you sign the documents and funds are exchanged, you get your keys, and you become a homeowner. And those 5 steps, well, let us sort of compress this into what you see on the 14 steps that you see on the screen. But, write those down or take a picture. But here's what I want to share with you is that, I've been doing this a long, long time. And it truly is much, the market currently is a buyer's market. And, I can tell you personally, even in my own neighborhood, houses are sitting. And I can tell you that just recently, we've assisted several buyers with going in and either negotiating contract and or finding ourselves in a competitive environment. And we won because we were pre-approved. And the way that we wrote the contract in our partnership with the real estate agents is there's no contingency. So think about it. If you're a seller, right, and somebody's giving you an offer on their home and you're getting an offer from someone else, and your offer, because you came to this class and because you worked with Nick and you worked with me and you worked with Natalie, is, hey, I'm making you an offer, but I don't have financing contingency. I'm approved. Hey, I don't need an appraisal contingency because my lender will get the appraisal done quickly. And then there's something called an option period, which generally gives you 10 days to inspect the property. And what we do is during that 10-day time frame, we have you prepared to execute during that 10 days to get the appraisal done, get the approval done, get the inspection done. And I can tell you, here's how it works is I had a property last year. The sales price was $580 and the appraisal came in at $530. $50,000 difference. Our buyer was approved. The appraisal was done. and they were still in that option period. And here's why the option period is so important. You can cancel for any reason at all and get your earnest money back. So what did we do? Hey, we went to the seller and we said, here's our termination, because we can cancel for any reason. Here's our appraisal. And our appraiser says your home is not worth 580, it's only worth 530. Here's our approval with our lender's underwriter's approval. And oh, by the way, here's the inspection. Everything looks great, but we're only going to pay you $530 for the house. The seller didn't hesitate and accept it. And that's the kind of preparation we're talking about. Putting you in a position to win the offer, putting you in a position to leverage negotiations through education, empowerment, execution, and experience. Hey, I consider it an honor to be a part of folks' lives in this process, to be a part of their lives in this journey.